this time of the year, we get flooded with predictions about what's next for Australia's housing markets. Some of them are useful and a lot of them are just noise. But every so often a report comes around that genuinely moves the needle and helps us see the bigger picture. And Domain's forecast report for 2026 is one of those. It paints a pretty fascinating story. Record prices in every capital city, rents still on the rise, and perhaps the most powerful first home buyer surge we've seen in decades. And it's not just more of the same. The data suggests our markets are shifting into a whole new gear, driven by policies, sentiment changes, and the slow rebalancing of supply. And there are some interesting twists as to how Domain sees our housing markets play out over the next 12 months. So today I've invited somebody who lives and breathes this data, Dr Nicola Powell, Domain's Chief of Research and Economics, to help us unpack what's really coming in 2026, why this cycle is going to be so different, or this stage of the cycle, and what the winners and losers might be. Hi, I'm Michael Yardney and welcome to the Michael Yardney podcast. Look, after 5 decades in property investment, I've seen about every cycle, trend and so-called crisis there is, and I know how confusing it can be with all the mixed messages out there. Everyone's got an opinion, but not all of them are worth listening to. But those of Dr. Nicola Powell, backed by the research of Domain, are definitely worth listening to. Now, twice a week I try to cut through the clutter to bring you clear, practical insights about to build wealth through property. We offer proven strategies, smart psychology, and lessons from some of Australia's leading experts. So whether you're just starting out or already well on the way, my aim is to help you make better decisions, grow your wealth safely through property investment, and build a life of financial independence and choices. So let's get into Domain's forecasts for 2026. Hi, Nicola. Welcome back to the show. It's always great to have you here.
Thanks, Michael. So good to be back.
Now, I wanted to talk with you about Domain's report, the forecasts for 2026, a 25-page, very detailed report. So before we get into the numbers, tell me, how many coffees did it take to produce a report of so much detail?
Look, Michael, I think let's just say that my coffee machine is going to apply for long service leave. It's well worked, and I think we probably crossed into double-digit coffees around page 18.
Well, I know you've got a team behind you and all the internal data in Domain. So I guess what I'd really like to do is have a look at the big picture first, and then we can dig down into what you expect happening in our housing markets around Australia. But let's start with the headline. Domain's forecasting record high house and unit prices in every capital city by the end of 2026. What are the big forces that are going to give us this synchronized upswing?
Look, it is an interesting one because, you and I know that what we have had is previous cities that normally are quiet achievers. They don't see too much growth, that have really outperformed. That is Brisbane, Adelaide and Perth. But what we have got predictions for next year is all capital cities. So that's including Canberra, that's including Melbourne, which we know have underperformed.
Yep.
To see modest rates of price growth. And I think, the main forces are obviously the cash rate. That is still going to have an impact next year. Supply in some of our cities is now actually falling, which is a good indication. If overall supply is starting to tighten, that means that the market is shifting. And of course, the expansion of the home guarantee scheme is going to create some tailwinds for price.
Isn't it? So your report describes 2026 as a year of two halves, early year momentum and then a bit of a cooling because we're going to meet affordability ceilings. Now, that doesn't actually mean that you think prices are going to fall in the second half of next year, 2026, but what do you see happening?
So, it doesn't mean that. I think what it does mean is we're seeing momentum build at the moment. That's been happening. It started to happen over late winter and it's continued into the spring selling season. And what we're expecting is that momentum is going to continue, particularly into the autumn season. What do you
mean by momentum? Could I interrupt you, please?
So, what I mean by momentum is we're seeing clearance rates rise, we're seeing buyers come off the sidelines. Ultimately, I think it's an indication that confidence amongst buyers is starting to return. We've also got confidence rising amongst sellers as well, particularly reacting to rising prices. But ultimately, what we're seeing is homes are being sold quicker than they're actually coming to market. And that's what's absorbing the overall supply that we've got across many of our capital cities. We're seeing that overall supply actually lower than what it was this time time last year. So we know that, I mean, clearance rates have been growing, and they've been much higher than what they previously have been, particularly when you compare it year on year. And so the year of two halves comes in with, it's a really nice way to describe what we think is going to happen next year. We think the first half, the first 6 months, is going to be much stronger than the second half of next year. And the reason being is the flow on impacts of the three cash rate reductions we've already seen this year still having an impact and a marked impact on buyer activity and capacity, and also the expansion of the home guarantee scheme. That is still going to have flow on impacts. And I think it's actually having impacts on other buyers. You know, there's been narratives out there that investors have been trying to get in before the first home buyer expansion of the scheme comes
Yes.
play. So, and I think by the second half, particularly if we don't see any more cash rate reductions, I think this is when we're going to start to see that affordability barrier kind of really start to stifle a bit of activity.
Well, first home buyers are back, but so are investors. And the most recent house finance approval figures are showing that investors are making up a bigger percentage of the markets all around Australia, Nicola.
That is absolutely the case. I think we anticipated this to occur, but I think when we actually saw it coming out of the numbers, the jump in investment activity was quite large. And what we know for housing finance, it is a good leading indicator of buyers in the market for the next kind of 6 months, roughly. And we know investors react to capital growth, and that is exactly what is happening. And they're now even starting to trickle back into Victoria, which I think is
Yes.
pretty much the surprise element. But I think gross rental yields have improved in Victoria. So I think probably the numbers are stacking up a bit more. And also they're chasing potential for capital growth with the value that Melbourne has built up over time. But rightly so, investors have come back in. I think what we might start to see when we see the next quarter of data from the ABS on housing finance is we might start to see more first home buyers carving a bit more back. And it's going to be an interesting landscape when we've got first home buyers and investors going head to head.
Well, for similar priced properties, we know first home buyers are back because of the first home guarantee scheme, which actually has been a game changer for young people wanting to get into the market. It's been the fact that now they can get in with a 5% deposit, no caps on how many people can use this scheme or what their incomes are, but what they can borrow up to, where the government's going to back them and they don't need lenders' mortgage insurance, is 1.5 million in Sydney, 1 million in Brisbane, 950,000 in Melbourne. So it's not just at the lower end of the market. It really is going to allow them, if they have the serviceability, Nicola, to buy median price properties in these capital cities.
Absolutely. It's such a game changer, I think, that part of the expansion of the home guarantee scheme, because previously the lower property price caps really were good coverage for units, but didn't give much choice, particularly in markets like Sydney for houses. And the lifting of that property price cap means that it captures many more suburbs for houses in the middle and even outer suburbs. So it does provide more choice. But I think with the expansion of the scheme, what it does do, I mean, the removal of lenders' mortgage insurance, it's not really encouraging first home buyers to go to market with a larger deposit. And I think what we are going to see, and we're not the only ones saying this, there's many research institutes out there that have done analysis in this space and around the bringing forward of demand. And that is really what's going to weigh in and lift property price. So our expectation is going to be unit prices, and it is going to be those middle and outer suburbs for house prices. And I think it's going to make a marked impact on a market like Sydney, which is a very challenged market to get access to.
Well, it's not the serviceability as much as getting a deposit that stopped a lot of first home buyers getting into the market. Now, some are lucky enough to have the bank of mum and dad help them, but it's really saving that deposit at a time when their rents are higher, their cost of living is higher, and let's be blunt, they're also enjoying their lives. Interestingly, the first home buyer scheme then is going to help people, but just recently, one of the banks, UBank, is now saying they're going to scrap lenders' mortgage insurance and people can get in with a 10% deposit. Now, that's interesting because on the other hand, I'm hearing APRA sort of murmuring that, hey, there's too many investors in the market. Banks have got to be a bit more careful. Really, property is a game of finance with some houses thrown in the middle. So if finance is easier and freer, our housing markets are going to keep increasing, aren't they?
Look, a housing market, property prices, you and I both know that you tend to find that the upswings are much longer than the downturns that unravel. We have got a high level of investor participation. You know, in some of our states and territories, it's the highest participation levels we've seen on record. In other markets, it's the highest we've seen since around 2017, 26, in terms of the proportions, the percentage finance going to investors. And then it kind of, it is a very complex environment, right? When we last saw this back in that kind of 15 to 2017 period, we saw macroprudential measures put in place.
Yes.
Got
Yes.
risky lending. That environment is very different now. I don't think we have much risky lending going on. And even when you look at the nitty gritty of housing finance, even the investors that are in, they're high net worth. They've got lots of leverage. So the risks, I think, are not there, but the risk is obviously elevated property prices, which is why, our forecasts are for a much stronger first half. And that is going to capture that wave of investment activity that we've seen come out of the most recent housing finance.
Well, one of the other finance changes that have occurred over the last little while is Macquarie Bank stopped lending for trusts and super funds. They're a bit concerned about some investors doing things the wrong way, or actually more being guided by people who shouldn't be guiding them into using the wrong structures to enable them to get more finance than maybe they can afford. So the finance game will be interesting as it plays out next year. But I do agree with you that more first home buyers are going to be coming in the market. And as you suggested in your report, it could even be up to 20,000 in the first year. Now, again, not everyone can do it in October when the scheme came in last month. Some are on leases in their current premises. Some are still living at home with mum and dad. Some aren't ready at that stage of their life yet. So it's something that's going to continue on over the year.
It absolutely is. And I think that the great thing about this scheme is there's no deadline. With many first home buyer incentives or schemes out there, they come into place for a year, they have a deadline, and those types of schemes really create a vacuum effect of this high level of first home buyer participation. We saw it back in, around 2009 when we saw that first home buyer grant double and this wave of first home buyers hit the market and we saw some elevated price growth. I think what we'll likely see is it is going to be ongoing. It brings forward a whole lot of demand, but I think it will start to normalize over time. We're going to see that big wave of people that were almost there or utilizing the scheme because they've got, the lower deposit. It is going to support property price. But the other thing, Michael, I was thinking about as you were talking about lending is, Trump's 50-year mortgage statement, and
Yes.
it's been so interesting watching that conversation unravel in Australia. I mean, I hope that we do not bring 50-year mortgages to Australia. We're not set up for that type of landscape. And ultimately, when you're talking about 50-year mortgages, it really just is a symptom of extreme affordability pressure and really demonstrates you've got no other lever to press in order to help affordability.
Well, it lowers your monthly repayments because you're paying back the loan over a longer period of time, but it really much more than doubles what your total repayments to the bank are going to be. So yes, it'll be interesting to see how the finance world plays out. I guess it'll also be interesting to see what happens with interest rates. The markets are not expecting any more interest rate cuts from the Reserve Bank in the near term. And we know that just recently, a number of the banks have increased just a little bit, but increased their fixed rate loans for home buyers and investors, which is a suggestion that they similarly don't think we're going to have any rate cuts, at least for the first half of 2026.
It's been like watching a roller coaster, is the way I would describe it in terms of the market outlook for the cash rate. We track it and we capture it at points of time. And it's really interesting when you plot that on a line graph around, this is a narrative that Australians are digesting at various points of time. And it has changed so rapidly. We were expecting another rate cut this year, but that's been dashed. We were expecting
Yes.
a rate cut early next year. That's now looking perhaps unlikely. If we base it on the market implied yield curve today, which is basically the market's betting on where the cash rate is going to go, we could already be at that low point. We may get one more next year, but a lot of the banks have actually changed what their outlook is for the cash
Yes.
rate. I think my learning is in the years that I've been tracking these developments, it does change. And I think my one learning is it can change quite rapidly. I think there is a lot going on. The re-acceleration of inflation is probably really paves the path for the RBA to continue its cautious approach, which we know it has been cautious in its rate reducing cycle. But I think my learning is the outlook can change. I think the cash rate is still a little bit restrictive. And I think When you read the minutes of the RBA statement, they signalled they'll only entertain cutting if the labour market deteriorates. I think it is a watch and wait scenario, and their decisions are all based on data.
Yes, well, their data's changing now too, rather than the big quarterly ones that they were waiting for. They're getting more confidence now. There's only monthly figures, and they're the only ones they're going to get now, the monthly ABS CPI figures. So let's see how it plays out over the year. We know that one of the big factors in property is supply and demand. We know there's more demand. We've already explained that, from home buyers, from investors, from first home buyers. There's a lot of people who've got significant equity in their property that's going to keep the property markets going. So people often ask me, Nicola, well, why should prices increase? I remember a year or so ago, PEXA came up with the figure that about a third of all transactions in New South Wales during the previous year had no mortgagee involved. We know there's downsizers, right sizing. There's the bank of mum and dad helping their kids and their grandkids now. So there is a lot of money, because even though the housing market has risen to, there's now suggested it's $12 trillion. And I remember, it wasn't that long ago, we were talking about $9 trillion of the total value of the residential real estate market. The debt against that hasn't risen anywhere near as much. Is only about 2.4 trillion when I say about, but that's a 21% loan to value ratio. So the housing markets are pretty secure. Sure, some people are going to overcommit themselves. Some people, first home buyers, are going to bite off a bit more than they can chew, and some investors may have bought bad properties. But there's quite some stability there, isn't there?
Absolutely is. And about 70% of Australian household wealth is tied to the value of our homes. So it demonstrates how significant and important it is to the overall economy. And when you see figures like, estimated value of the entire Australian housing market at over 12 trillion, that's larger than superannuation assets. It's larger than Australian share market. It plays such an important role. And you really made such a poignant point there around the equity and the leverage that we have in our homes, because many of us have owned our homes for a while. And
Yes.
you see that equity grows. And that does help to continue that property price cycle. I think the edge is that it is very challenging, I think, for first home buyers, and that affordability conversation has become so poignant in recent years. I don't think I've seen such a focus on affordability, and particularly a focus on supply. We still, are not building enough homes to meet population growth. And I think what I've noticed in recent months is around this conversation around supply in the right areas. This concept of building supply where actually people want to live, and building the right type of supply. But yeah, I mean, for first home buyers, it is challenging. And I think one of the important reminders for first home buyers is to not overextend, keep within your means. I think we all learned a very big lesson when we saw that most aggressive rate hiking cycle in a generation.
Yes.
Having that buffer is very important.
Well, let's work around the capital cities and look at Domain's report for each state. Now, as we work through these, we're going to see that people's equity is going to increase considerably. So what we mentioned a moment ago about the general amount of equity homeowners have got, they're going to feel even better at the end of 2026, when their house has probably earned as much as they have in their day job, Nicola. Let's
Yes.
start with Sydney. We'll work around Australia, and again, in no particular order other than why you've done it that way in your report. And I'll leave a link in the show notes to your report. But what are your thoughts about the Sydney property market in 2026?
So has been a bit of a pivotal moment, I would describe it, for Sydney. We are forecasting further price growth for the calendar year of 2026. So 7% increase for house prices, which pushes that median price to 1.92 million. And we've got a forecast of 4% for unit prices, bringing the median unit price at just over $890,000. What you will see, though, is our forecast for Sydney house prices is going to lead, which means it's going to see the strongest rate of house price growth out of all of our major capital cities. But what I would say is that rate of price growth is slightly lower than what we're expecting for the entire year of 2025. So house prices, we're expecting a 9% increase by the time we close this calendar year, and then we're expecting a 7% increase for next calendar year. Now, I think it's interesting with Sydney and Melbourne. I'll capture Melbourne in this comment. We are expecting Melbourne and Sydney house prices to see the stronger rates of growth relative to other capital cities. The core reason being is these markets historically have been more sensitive to changes in the cash rate. We've seen a lower cash rate, and it is amplified through their housing markets much quicker than other capital cities. A market like Sydney, high property price means that you need to be highly leveraged to get into that housing market, and generally also is amplified through those housing markets that have more investment activity, and that tends to be the case for a market like Sydney.
I guess what you're suggesting is that the impact of the 3 interest rate cuts in 2025 haven't fully worked through the market yet, because we're not expecting another one just anytime soon.
That's exactly what we're suggesting. We are expecting that the 3 rate cuts, it takes a while, I think, for confidence to rebuild and also for buyers to find their right home. And so we're expecting that the 3 rate cuts that we've seen this year to still be impacting Sydney and Melbourne's housing market in the first half of next year.
Okay, so Sydney's going to lead the pack. Melbourne, see in your forecast that it's finally going to complete its recovery and end up with prices higher than at the end of the year than they were in the past, hitting a new high.
That's correct. It has been a bit of a slow burn, I think, for Melbourne. It's been underperforming. We've seen prices pull back, and then it really didn't do nothing for quite a period of time. It's slowly edged into a recovery, and we're seeing that recovery now is established. And what we're expecting, 6% increase over a calendar year, is quite modest for a housing market like Melbourne. We know that Melbourne tends to see these big swings, and we're not predicting that. But what we are predicting is a 6% increase. It's the second strongest growth out of all of our capital cities for house prices, meaning that, as you said, house prices will be at a new record high, so 1.17 million at the end of next calendar year.
Right. Brisbane's had a fantastic run, in particular with their apartment price growth. I remember it wasn't that many years ago when there was a huge oversupply and people said, oh, no one in Brisbane wants to live in apartments. Maybe they've caught up with the other capital cities, especially as prices have become less affordable. So what do you anticipate happening in the Brisbane property market, which was one of the strong performers last year?
It has, and I think Brisbane is one of those cities where we are going to see a marked slowdown in the pace of price growth. Not going backwards, we're still expecting prices to rise, but just not as fast as the double digits that we'd seen over recent years. So we're expecting a 5% increase in house prices over 2026 for Brisbane, meaning that median is going to sit at 1.18 million. And then for unit prices, Brisbane, we're expecting it to be the strongest capital city for unit price growth at 7%, meaning that the unit price is just sitting under $790,000. So both new records for Brisbane house and unit prices.
Adelaide was a strong performer for a number of years. Now, again, Adelaide, Brisbane and Perth at the beginning of this cycle a couple of years ago were much cheaper than Melbourne and Brisbane, but I can see how affordability caps are going to start affecting those cities. Adelaide, you're forecasting really strong growth for 2025, but 2026, you think it's going to be a little bit slower.
It will be slower, is our expectation. And I think, it just illustrates that the brakes are on, and I think affordability is impacting. I mean, we're forecasting Adelaide units 16% increase by the end of 2025. So we've still got a little bit of time left. But we've seen Adelaide units really perform strongly relative to other capital cities. It's pretty much been the best performing unit market out of all of our major cities. A marked slowdown. So our forecast for unit prices in Adelaide 5% for 2026, and for house prices 4%. So you can see, Adelaide's been unstoppable. It's always been described as this quiet achiever, slow rates of price growth, never really a market that goes backwards. That hasn't been the case over the past 5 years. It's almost been one of those unstoppable markets.
Hasn't it?
Yeah, it used to have the affordability edge, really does not have that affordability edge now. It's $1 million median house price. It's rubbing shoulders with the likes of Melbourne, Brisbane. It's up there now. I don't think we can describe Adelaide as affordable market when it does have $1 million median house price.
Perth, of course, has been a star performer for a number of years now. After underperforming for close to a decade, you're seeing the Perth market continuing to grow but nowhere near as much.
Absolutely. And I think, there's still some challenges for Perth's housing market. It's still seeing positive net interstate migration, elevated levels of overseas migration, economy performing well, really tight rental market too, one of the tightest across Australia out of our major capital cities. But I think this kind of interplay between that continuous price growth and affordability ceilings being reached is going to, in essence, slow down price gains. We're expecting and forecasting a 5% increase for house prices and a 6% increase for unit prices, meaning Perth is still going to be at a new record high. But I think the element that's interesting between that unites Brisbane, Adelaide, and Perth, these three capital cities, our forecasts show that we're expecting stronger rates of unit price growth for these three cities relative to house price growth. And
Interesting.
yeah, that's the affordability story
Yes.
in itself. Also, a bit of investor interest too. But as well as I do, we don't often predict a unit sector to outperform a house sector.
No, but this is changing with affordability and also how we are now accepting to live as well.
Mm.
Last capital city on your predictions is Canberra. Canberra underperformed for quite some time, but you believe it's going to complete its price recovery also.
Canberra has been one of those markets that has been very slow in moving into a recovery. I think we are expecting, prices are rising for houses at the moment. Units, it's been a bit volatile. But what we're forecasting next year is only a 3% increase for unit prices and a 5% increase for house prices. So this is modest paces of price growth. But what that does mean, it does nudge this capital city into a full recovery, which is a marked difference compared to what we have seen over recent years. And I think, I actually did a presentation in the ACT recently around what's happening in that market. And what's quite interesting is when you look at that pricing recovery for houses, it's very much being driven by the mid sector, so the middle price point, rather than the upper or the lower. And the same thing is happening in the unit sector. The upper end of house prices is also starting to edge more into the positive. So, yeah, some interesting dynamics, I think, unraveling in the ACT.
So overall, you're believing that the Australian property market's going to increase by 6%. Now, we know there's not an Australian property market, but I'm comfortable with that, Nicola, because it's not the double-digit boom time growth that some people would like, but it's sustainable. It means that we're not going to have a significant, we know each boom leads to the next phase, the downturn. This is sustainable for a couple of years at this level.
I think so. I think it's more healthy growth rather than double digit that no one can keep up with. I think, ultimately, you really need property prices to rise in line with wage growth. And we know that
Yes.
two things have been so disconnected for many, many years. And there has been this widening gap between where home prices are and the actual capacity to pay for a home. That's improved, obviously, a little bit with 3 rate cuts, but there is still a wide price gap between where home prices are and the capacity to pay for a
Now, we talked about the capital cities with regard to capital growth, but just quickly, how do you see the rental markets playing out over 2026?
The rental markets, I think we have forecast rental price growth. I would say it's very modest. It's probably in line roughly with inflation. I think most of our cities are either going to see, and when I say modest growth, just to put some figures behind that, we're forecasting 3-4% increases in rents. Across our major capital cities. The only ones that are going to see a little bit of a reacceleration is going to be Sydney house and Melbourne house rents. Even that 2% increase for Sydney house rents in 2025, we're expecting a 4% increase next year. For Melbourne, 1% increase. They pretty much did nothing this year, and we're expecting a 2% increase next year. So still very modest rates of price growth. So again, those double-digit rises are in the rear view, and we're expecting our rental markets to move into not balanced. It's still very much a landlord's market, but we're expecting improved conditions compared to what we've seen in recent years.
So, Nicola, we know that for the last couple of years, vacancy rates have been very low in many parts of Australia, around 1% or even less. Historically, supply and demand when vacancy rates are so low would suggest rents should have increased more over the last year than they have. We know in Melbourne, where vacancy rates have been particularly low, rents have hardly moved at all. Is this because of affordability and people just can't pay more?
The rental affordability ceiling, I think, has been reached, smashed, and I think that is helping to moderate rental price growth. And what we know is the rental market is much more transient. So if you're not able to meet rental repayments, it means that you move or you get a housemate, you're going to a cheaper, you see that shift, that demographic, that transient population shift occurs in the rental space. I think that's absolutely something that we've been seeing playing out. And it is very unusual. We've got to remember we've got markets like Adelaide and Perth that have still got, below 0.5% vacancy rates. This should still be, you would expect, producing stronger rates of rental price growth. And it's not happening. And I think that's that affordability ceiling really, really playing out.
Sure. So I'm going to leave a link in the show notes to Domain's report where people will be able to dig into all of this. But we're looking forward to another good year in property in 2026. Is there something, every year there's an X factor, something out of the blue that we can't forecast? So I'm not going to ask you to forecast that because if you did, it wouldn't be an X factor. But is there anything on the fringe that may derail these forecasts for you?
Look, I think for me, and I'm sorry to sound boring, but it's probably the cash rate. I think we know that the outlook for the cash rate has rapidly changed. And what, for example, if we see another couple of rate cuts delivered next year, it will change the outlook on our property prices and we will probably see stronger rates of price growth. I think many of us are going to be taken by surprise by the impact of the expanded home guarantee scheme on property prices also. But then on the flip side of that, this is the bottom, or we start to see rates being hiked next year. That may even slow down the
Yeah.
pace of price growth. So I think for me,
Sure.
it is the cash rate. It's not the only driver of property price cycles, but I think in that short term, it has quite an immediate impact.
So for people watching or listening to this today, what's the single most important insight you'd like home buyers and investors to get from your forecast?
Look, I think that the core thing is we are forecasting price growth, but it's at much more modest paces. And I think what that provides buyers probably is the confidence that they're not entering a market that's running away with itself. That's not what we're expecting. We're expecting price dynamics to be stronger in the first half. And so what you might expect to see is a stronger autumn buying and selling season. But then our expectations is those conditions are going to start to plateau and start to slow down in the second half.
Well, Nicola, thanks again. I love our chat. So you bring so much detail from Domain and this time their Domain's forecast report for 2026. You put it together in a very clear, practical way with lots of images, charts, graphs, which we'll be sharing when people download the report. What stood out for me from our chat is how different this next phase of the property cycle is going to be and how 2026 is likely going to be a year of two halves. But we're not heading into a frenzy. We're not going to head into a downturn either. It's actually been interesting, Nicola, that all the property pessimists, the bears, they've hibernated. You don't hear people anymore. They've gone home overseas or ever. Even social media has stopped saying we're about to crash.
Absolutely. I think they always come out of the woodwork, and I think it's much better having an outlook where we've got much more modest rates of price growth, not falls, not galloping away in terms of growth, but a much more sustainable path, I think, for our housing market in 2026.
So what I heard from you is we're entering a year shaped by policy, by improving income, the way buyers are going to adapt to affordability pressures. And yes, it's still going to be shaped by the chronic undersupply that we've been talking about for years. But the big change over the last few months and going into next year is really this expanded first home guarantee scheme, which is going to pull forward lots of demand at a time when interest rates are going to probably remain the same. So thanks. I think it shows that there is still an opportunity. People who've been sitting on the sidelines waiting for the perfect time, there never will be one. But yes, the best time to have bought was probably 2 years ago, at the beginning of 2023. when the market started to turn. The second best time is now to get in, because those who get into the market now are going to look back, and we get together 3-4 times a year. It'll be interesting when we chat at the end of 2026 and see how these forecasts have played out. But I think anyone who gets into the housing market this year, your suggestion, or now I should say, your suggestion is they're going to be very happy with their decisions in a year's time.
I think so. And I also think it's about making the right purchase too. It's all about
Yes.
information. But I think as well, it's also about arming yourself with information and making sure that wherever you're looking at purchasing, you have the right insights, data, and expertise at your fingertips. So you make a well educated purchasing decision.
Well, what I've been impressed with is that you and your team at Domain are now bringing out a lot more reports, a lot more insights. We run those on Property Update. Your team kindly share those with us, and we direct people back to Domain. So once again, thank you for providing these insights at no cost. Clearly, you're an information providing company, and you're wanting people to go to Domain to find out where their properties are as well. But you're doing a great job of service for the real estate community. Thanks for your time, Nicola.
Thanks so much for having us, Michael.
Well, as always, I enjoy my chats with Dr. Nicola Powell, bringing detail and data to show that 2026 is going to be a good year for property all around Australia. Hey, don't make a mistake, though, because not all properties are investment grade and not every property is going to perform well. That's one of the things I like about real estate. It's actually quite easy to outperform the averages by choosing the right state, the right location within that state, the right property within that location, and then obviously, you've got to pay the right price, but it's got to be done in the right order. We use a top-down approach at Metropole. In fact, we use an approach that starts by putting a strategic plan together for our clients and then helping them implement that plan, which means that my team at Metropole are much more than just buyer's agents. We help our clients safely create intergenerational wealth. We help them grow, protect, and pass on their wealth, and that gives them the choices and the freedom they want. But it all starts with a chat with one of our team. So the cost of doing nothing could actually be the most expensive investment decision you make. As you heard, the markets are going to keep moving on, whether you choose to do something or not. So why not take advantage of that? Have a chat with the team at Metropole. Last year, we won 3 awards from finder.com.au as Australia's leading and most trusted buyer's agent. What that means for you is you're going to work with a team that has got proven results for many, many decades working through multiple markets. We know how to help our clients avoid the pitfalls, the challenges. We've seen all the landmines, and we know what you can do. We're going to help you safely clarify your goals and ambitions. We're going to give you insights into the opportunities that are appropriate for you. We have no properties for sale, but we've got access to every property, so we're going to offer you a personalised pathway to move forward confidently without second-guessing every step. Go to metropole.com.au. I'll leave a link in the show notes, but go there and just organise a complimentary, obligation-free chat with one of our wealth strategists. Let us help create a roadmap for your wealth. The listeners and viewers know that each show I run a property trivia quiz. I ask you a question, I'd like you to leave an answer, and I've actually got 3 books that have just been updated. So each week, 3 people are going to win a copy of one of my books, a real hard copy, and then everyone else is going to, who leaves an answer, is going to get an updated report. And I've just updated the report based on a number of factors, including the latest report from Domain. Anyway, the property trivia question today is, what's the nickname commonly given to the middle area between the CBD and the outer suburbs where middle-income Australians often live? Go to propertytrivia.com.au. I'll leave a link in the show notes. Just go to Property Trivia, leave your answer. What's the nickname commonly given to the area between the CBD and the outer suburbs where middle-income Australians often live? propertytrivia.com.au. Everyone gets a report. Hey, don't worry if you watch this show a little bit late or listen to it a little bit late. Every entry counts.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to share a story with you about the backpack you forgot you're wearing. Look, every now and then life hands us a reminder disguised as something ordinary. A friend recently told me a story about a hiking guide who would start every trek with the same way. Before anyone took a single step up the mountain, he'd ask the group to place their backpacks on the ground. And then he'd say, "Lift your backpack and tell me how heavy it feels." And people would throw out numbers, maybe 5 kilos, 7, 10 if you packed badly, and the guide would smile and shake his head. The exact weight doesn't matter. What matters is how far you try to carry it without stopping. He explained, carry it for a minute or two, no big deal. Carry it for an hour, you'll start noticing the strain. Carry it all day without resting, your shoulders burn, your posture collapses, every step feels like punishment. Now, clearly the load hasn't changed, but your experience of it has. The longer you cling to it, the heavier it becomes. Then he'd look at each hiker in the eye and he'd deliver the real lesson. Most people walk through life carrying emotional weight as if it was welded to their back. A grudge, a mistake, a fear, a conversation that went sideways, and they never put the pack down long enough to recover. And you know what? He's right, isn't he? We all have our equivalent of an overstuffed backpack. The argument you replay on a loop, the decision you wish you made differently, the thing you said or didn't say that you keep chewing over, the fear you treat like a permanent companion. None of these weigh as much on their own, but carried non-stop without a pause, they become exhausting. It reminds me of the old Buddhist tale about that poisoned arrow. It's a story I shared with you in a previous Mindset message, where the man who delays treatment because he's so busy analysing the arrow, the bow, the shooter, the wood, and in the meantime the poison finishes the job. The arrow wasn't the real danger, the overthinking was. The same goes for the emotional loads we keep strapping to our back. The heaviness you feel today probably isn't from the event itself. It's from the hours, days, or even years you've spent lugging it around, tightening the strap, refusing to set it down. So my mindset message for you today is take a moment to notice what you've been carrying longer than you need to, that have been rubbing your shoulders raw, what memory keeps getting packed for every journey, even the ones that has no place in, and what story you've told yourself so often it feels like part of your identity. You don't need to solve everything today. Just loosen the straps, put the backpack down, give your mind a chance to breathe again, because the real weight isn't the burden itself, is it? It's how long you insist carrying it. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardley Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. And I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardley Podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Well, just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardley Podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?